Does it have to be property or pension? Why can't it be the same thing? As an organisation, we are, with due modesty, quite proud of our role as financial innovators. We spend a great deal of time and effort adapting financial products to solve real problems that we see as an issue in the marketplace. And one of the major areas that we have been quite rightly recognised for is innovation in the pension space, and very particularly making pensions hugely relevant to small business owners. But of course, small business owners are not the only people that own pensions and have a relationship with long-term savings. And one area that is clearly in need of some financial innovation is how we make pensions relevant to and attractive to younger people who are in work. We're all frantically running around trying to get them to understand the importance of long-term pension savings and the tax benefits associated with that, and the fact that you nowadays are absolutely responsible for the outcome of your own retirement. But of course, when their priority, first and foremost, is saving up for a deposit on their first property, and let's assume that the vast majority of younger people don't have sufficient spendable income to cover off both properly, you have a conflict of interest. Is there an answer to this? Can we square this circle? Can we enthuse our younger working population around the idea of paying money into a pension pot whilst also helping them to get on the housing ladder? And the answer is, I think we may well have come up with something that will do just that. One of the negatives that in perception around pensions is the idea that it's locked away for a long, long time. For every pound you put away into a pension pot, you're getting something like £2 or £3 on top, both in terms of tax relief and employer contributions and so forth. That makes the acceleration of value within the pension scheme happen extremely quickly, roughly twice the speed that you would be able to accumulate money outside of your pension pot. So we're arguing that on a one-time only basis, an individual should be allowed to save into his or her pension pot to the point where they have accumulated enough to fund realistically a deposit on a first property, let's call that £30,000 or £40,000 typically across the UK, and then be allowed to borrow from their own pension in order to fund the deposit for their property and repay their pension scheme over the lifetime of their mortgage. That means not only are they being able to get on the property ladder more quickly, but also they're positively engaged with the pension scheme itself. They've got into the savings habit, they're benefiting from the tax release, and of course the pension scheme is benefiting from the interest that they will pay back to their pension over the lifetime of their mortgage. So we see this as a potential game changer in terms of how young people, particularly early in the world of work, view the relevance of pensions and their ability to get into the housing market at the same time. We think it's explosively positive, and we did quite a lot of detailed work around this and have shared our ideas with the Treasury, and it will be really interesting to see what the reaction is. We're all for it, but we'll wait and see.